Good morning, everybody. Welcome to a wonderful, rainy, easy to sleep in Thursday. And I see that all you diehards are already up here in class. Thanks for coming. Um, Hope you've had a good week so far. Uh, I have, not that you care or should, uh, but it's been pretty good. Time out. Okay, we have a lot to cover today, and I hope that we'll get finished with depreciation today. That's the goal anyway, and maybe a little beyond. Excuse me. Morning announcements are, uh, first of all, kind of a wrap up on the homework that was due yesterday, and I know that I got several emails and contacts about that. Uh, it was for many, well, maybe not for many. I didn't hear from a majority of you, but several people struggled a little bit with that. And struggling is not a bad thing. Struggling can be a good thing if you're learning why you're struggling. And just a tip on some of that that might help you in future homeworks. You know, quite often the homework uh, follows examples that are in the text, and the examples are there for a reason. They're there to guide you and educate you and give you uh, uh, examples of how to solve these problems. And you might notice many of these. I'm not going to go through. I was going to kind of go through each of the parts and say, okay, this looks like example such and such, and this looks like example such and such. So if you're struggling and it seems difficult, a great tip is to always go back into that chapter where the homework is located and look at in the text part, look at the example problems. And quite often they will, pardon me, uh, they'll show you exactly how to solve part of it, or they'll be very close, and it'll be close enough that you'll be able to take that example and transform that into the particular problem you're trying to solve. So it's always a good tip. If you're not kind of leaning on your book, you can lean on your book. It's a good book. It's a good text. It's covering the material that's relevant and important, and that also are the kinds of questions that we're asking on the homework. So again, I encourage you to use your text, and if you read through there, it's amazing how much it can help you understand. Of course, those of you who are logged in here already, you may not have had any difficulty with the homework, in which case, hooray, congratulations. The depreciation quiz 4, and I called it the depreciation quiz. There may be a couple of accounting entries on there. I don't know. I haven't decided that yet, but I'll let you know very, very soon because I want you to have time to prepare for it. Anyway, that's next Thursday, not Tuesday. It's going to be Thursday, because there will be some homework. I've already determined it, and it's going to pop up. It'll be up there later this morning that will be due next Wednesday. It's only a few problems, 6 or 7. Haven't decided about the 7th one on depreciation. So it's out of chapter 5, and that will be available and due next Wednesday because I want you to do some practice on those on the depreciation problems. So that's coming, and therefore the depreciation quiz. I don't want to have it Tuesday because well, I just don't want to have it Tuesday. We'll have it next Thursday. Let me see. So I did. If you didn't notice in the announcements, I posted a video that I made I don't know if I made it Tuesday or Wednesday or yesterday, but on depreciation, the first three methods that we talked about, straight line depreciation, sum of years depreciation, and declining balance depreciation. I made a video working on problems from the back of the chapter for three of those, and there's an accompanying spreadsheet that's posted on Canvas. So if you have a hankering to watch that video, or find that it might be helpful, and I think it might be helpful for the homework, feel free to take advantage of that. The spreadsheet that's contained is one that I use to demonstrate solving the problems. So the solution is there, and I think I made them generically. You might be able to use those to your benefit. So that's I think that's about all of the announcements. You know, we're closing in. Don't forget homework 5. I'm posting homework 7 today. Homework 5, remember, that's the ratios for the publicly traded company is going to be due here in, is it 2 weeks from today? I think so, or thereabouts. Don't my memory isn't that good, so don't take me at my word today. But anyway, don't forget that if you haven't started it, this would be a great day to start it. It's just nasty out. And we're moving pretty quickly toward Thanksgiving. I'm sure you all are excited about that. Maybe, I don't know what I haven't checked Tech's website lately to know. I think you're all going home at Thanksgiving or something and finishing online, or of course for you it doesn't make any difference. Anyway, and of course in 3 days, daylight savings time disappears. So don't forget to set those clocks back. It's my favorite day of the year, actually. When you get an extra hour, you know, some people use that extra hour to, you know, be productive. I use it to sleep, and I really look forward to it. So I'm excited about this weekend. I'm not as excited about Halloween. Reformation Day is what I celebrate. Okay. So let's get moving here. I do want to point out, very first thing, we're going to try to look at the textbook on the other camera here today. The cameras, you know, webcams aren't necessarily built. Maybe very expensive ones are, to zoom in and zoom out and do the kinds of things that I prefer to do. I'm a cheapskate, so mine's pretty normal camera. And I was going to show you this, but I'm going to skip showing you this. I just want to point out that there is a typo that if you follow the sidebars in the textbook, there's a typo in one of them for an Excel function. And if you type in what they tell you to type in, you get nothing. I mean, you'll just get, you know, Excel will think you're nuts. Anyway, it's sidebar 5.3 it's on page 69 or 68, pardon me, in my textbook, in the 4th edition textbook. And it says there's an Excel function VB, so Victor Bravo Delta, VBD, and there is no such function. It is V Victor Delta Bravo, VDB, declining balance is what it's for. And there are Excel functions, as I pointed out, for many of these depreciation methods. You have to be very careful how you use these Excel functions. I don't recommend using them necessarily. The straight line one is simple and straightforward. The other ones, I think you're better off just using the formulas and establishing those depreciation rates yourself. And that's what I do in the examples I work and things like that. So anyway, little typo in the text that is, if you try to use it, you'll wonder what am I doing wrong, because it's that bad a typo. Okay, let's review briefly, if we can, where we left off last time, and that was the declining balance method. We left off, we worked through declining balance. I'm going to show you a spreadsheet here with those three methods, the three that we talked about last time. I want to just kind of close the deal on those three before we move into Mackers. So we left off with the declining balance method, and primarily we will use, there actually is a regular single declining balance method. And you'll notice, let me go back a slide, the rate or the percentage that you depreciate from your asset, from the book value of the asset, actually, each year is R sub M is equal to 2 over N for 200% declining balance, 1.5 over N for 150% declining balance. There actually is a regular declining balance that's 1 over N that is kind of like straight line. It's not straight line, but it's closer to straight line. The greater the percentage here for the declining balance, of course, the more accelerated is the depreciation that you're using. So now I have revised and updated the spreadsheet that I shared with you for class last time that we mentioned just briefly. I have updated that. I changed some things around because I didn't like it. And I also put onto that spreadsheet problem examples that we're going to work through today. So I'd encourage you to go out to Canvas if you haven't, under files for class, class files or files for class or whatever it's called, and go to today's date and grab that new spreadsheet, because we'll be using that today. And I want to pull that up, if I can find it on my list. And here it is. And you'll notice there's some problems we're going to work down here, tabs for those. We'll get to those here in due course. And I also changed up this first tab, this first worksheet here, to have the depreciation next to, the book value right next to the depreciation instead of in a separate table. So remember that we did on brief review for Tuesday, we calculate, here's our example. P is $155,000. F is $15,000. That's the salvage value. The life is 10 years, so N is equal to 10. And we calculated first straight line depreciation. And remember, straight line depreciation is, I did use the Excel function here. Remember, it's just P minus F, that term, divided by N. And that gives us a straight line amount for each year. And here's the book value. It starts out at P at time 0, and then at the end of year 1, it's the book value minus the depreciation for that year to get the straight line book value at the end of year 1, and that continues down. And we said, yes, indeed, at the end, after 10 years, because the way the formula works, if you calculate that simple formula correctly, after 10 years, the book value of your asset will be the salvage value, F, and it is $15,000. So we did it correctly. It's always a good, ho-ho test is to see if that matches up as it should. Now, double declining balance, that's what DDB stands for. That's 200% declining balance. And this would be our, the 2 over n is 0.2 because n is 10. That means we're going to depreciate 20% of the book value, of the remaining book value each year. And here we go, declining balance. So in year 1, we depreciate, I'll put the formula in here, equal, the 0.2 is in H9, should be $H, $9 times the current book value, or the remaining book value, we could say, and that's $31,000. That's 20% of 155,000. And of course, the book value then at the end of year 1 is simply the book value at the end of year 0 minus the depreciation for year 1, $124,000. What's the depreciation in year 2? Well, it's 0.2 times, just copy that down. It's 0.2 times the remaining book value, the current book value at the end of year 1. That's 24,800, and that leaves us with an ending book value at the end of year 2 of 99,200. So again, each year we calculate 0.2 times the remaining book value, the current book value, to get our depreciation amount for that year, and then we can then subtract that from the book value to get our new book value. And if we do that, we come all the way down to the end. You can see that the depreciation decreases every year, but it's always a constant amount of the current book value. And the book value decreases. It doesn't get down to 15,000, but well, that's the way it goes. And at the end of 10 years, that would be our straight declining balance book value. And then the sum of the years, remember how that works. The sum of the years depreciation, and I built the formula in to this spreadsheet, so you already have that here, and I'm not going to go through the it's P minus F times, so it's always going to start with P minus F, that amount to be depreciated, times the number of years, this term here, the number of years remaining to be depreciated, divided by the sum of all the years, which is 55. And so that's the formula. And again, it's, this finding the new book value is always the same. It's the current minus the depreciation for that year. And so we can copy that down. It says we can copy that down. I can't make a copy. Sometimes it does that. I don't quite understand, but we're going to make it work. And there we have it. And lo and behold, as expected with the sum of the years, we will depreciate it down to the salvage value, 15,000. So the straight line and the sum of the years are built such that you will depreciate it to the salvage value at the end of the life. So there's those three. We talked about those last time, so I hope you understand that. Anyway, in the extra video that I provided, I go through those three in detail, solving problems. So I think we're good to go on those. Now let's switch gears a little bit and talk about Macker's depreciation. And Macker's this is kind of the punchline, if you will. Macker's depreciation is so it is the modified accelerated cost recovery system And history isn't something you're interested in, but since I'm interested in and I have the floor, I'm going to tell you just a couple of minutes worth of history here. Um, Back in the late 1970s, the country was going through, boy, I'd give you a warning here with the election coming up, but I'd be accused of electioneering, so I won't. But let's just say that the country was in a difficult place and things just weren't working right. Um, a term was used by our then president, and that term was malaise. A malaise has overcome the country. And interest rates, as I mentioned earlier, my home mortgage, I bought a new home in fall of 1981, my first home. And I paid 13%. My mortgage rate was 13%. Inflation was quite high. Production was down. It was just kind of a crummy economic time. And so uh, there was a new administration took over with the I will, I'm a capitalist all the way, and I think you need to free up organizations to do what they do best, which is to provide jobs and help the economy grow. Well, there's ways that you can do that. And believe it or not, I know depreciation seems like a ho-hum, boring kind of gee whiz accounting detail kind of thing. But think about this. If you get a tax break, maybe a significant tax break, by purchasing productive assets like machines or tractors or whatever it might be to help you produce, if Uncle Sam will help you pay for that, you're more likely to buy something to be more productive because somebody else is helping you foot the bill. And when, so that's good right there. But just think when you're buying an asset, where does that asset come from? Well, some company or somebody has to build it, has to make it. And that means more employment and more business for them. And when they have more employment and more business, they need more assets, and they get the asset break from the government uh, through in our case, what we're talking about here is attractive depreciation terms. That all of a sudden there's a lot more activity in the marketplace, and all that activity in the marketplace generates revenue, and that revenue helps people make money, and people are employed, and businesses prosper, and um, so and that multiplies manyfold. And as it turns out, ironically, of course, uh, when you do that and you get more activity, you generate more revenue for the government, turns out. So there's something called the Laffer curve. Check it out sometime. And kind of demonstrates that you can actually lower tax rates don't necessarily mean, and typically don't mean, less revenue. They mean more economic activity, which oftentimes means more revenue. That's another topic. Anyway, so a lot of this thought was going on in the very early 1980s, and they wanted to give manufacturers and constructors, everybody out there in the marketplace, an opportunity to get more active, to make things happen, to churn things up, to build business. And one of the ways that they did this was through, believe it or not, legislation on depreciation. And so they wanted to accelerate depreciation so people could do even more. And later this morning, we'll talk about things they've recently done to do that, to jack that up a step. Anyway, so they passed this Congress passed the accelerated cost recovery system, a law that there was a lot of other things going on. Uh, Legislation passed, tax reductions and things. But the ACRS, Accelerated Cost Recovery System, allowed an acceleration in depreciation. Well, in 1986, so it wasn't too long down the road, they changed that, and they advanced it, if you will, a little bit, and therefore they passed this thing called the Modified Accelerated Cost Recovery System, and that's what we have, and we're still using it today. That shows you how often is something that effective created that is used 35 years later in pretty much the same form, and that's MACRS, the Modified Accelerated Cost Recovery System. And the way that works, I'm going to show you a few slides, and then we're going to dive into it. So the Modified Accelerated Cost Recovery System, MACRS, is the IRS rule for depreciation. When you depreciate for tax purposes, just standard straight line, standard SOI, standard DDB, all those, that's fine. And you might want to do that for a particular set of books at your company for management purposes, for visibility purposes. But when you do your finances for tax purposes, you need to use MACRS. And it does use some double declining balance, but it's adapted, and it does use some 150% declining balance, but it's adapted, and it does use some straight line depreciation, but it's adapted. And so these rules surround this Modified Accelerated Cost Recovery System. There are rules about when you put the asset into service, when you take the asset out of service. If we were to, we're not doing it, but if we were to dive out into the IRS website and get into the Modified Accelerated Cost Recovery System pages, hundreds of pages on the web. It is deep. There's details. It's very difficult, perhaps, to wade through some of these things. So fortunately for you and me, in class, we can only look at just a sliver, the smallest sliver of MACRS, enough so that you know that it's out there and it's very important. And like hailing a taxi or an Uber or whatever an Uber Lyft. I don't know. I don't use them, but you all do. And just like getting one of those, get yourself to an accountant and make sure that you're doing the right thing. You're depreciating the right way with your assets. It really is a financial assistance, as you will see when we talk about the tax effect of depreciation. So anyway, it's very, very complicated. We're going to make it pretty simple. And the good news is that ultimately it is simple. If you know what table to look at, calculating a depreciation schedule is a piece of cake. It's very easy to do. You just have to know what table to look at. So you'll notice here, there's a graph, and you can see the effect here, different periods for depreciation. This is just, you're not going to be generating these graphs, but you can see the cumulative depreciation. I mean, it accumulates very quickly, so it's very accelerated. The government will tell you, by the way, how long you can depreciate your asset for, and they will tell you what its salvage value is going to be. And that salvage value, by the way, will be zero. It will have you depreciate your assets down to zero. Now, like I said on Tuesday, that doesn't mean it's zero. It doesn't mean that your ultimate value of your asset turns out to be zero. It just means that the government will let you depreciate it all the way to zero. But if it's not zero, there's some tax implications and there's a homework problem for that. We'll talk about those things as well. So that's MACRS. Here's some of the rules. When you place an asset into service, so you have the calendar year, for example, and when did you place this asset into service to depreciate it? Well, there's a standard general rule, and the general rule is called the half-year convention. And that means if I put an asset into service in 2020, I can depreciate 1/2 of the depreciation due for the year. And that means if I calculate the depreciation, we'll demonstrate this, calculate the depreciation for year one. Well, I only get half of that in the first year. That's the rule. So I could have put it into service in January, in which case I'm getting kind of semi-cheated, right? I mean, it's been in service all year, but I only get half a year's depreciation. Or I could have put it into service in December, and I still get half year's depreciation. So in that case, I'm getting a great deal, right? Well, the convention is, hey, we're not gonna track when you put it into service. Just if you did it during this year, you get half a year's depreciation, and on average, things will work out. There's also a mid-quarter rule. If you put 40% or more of your assets that you have in service during the last quarter, you use a mid-quarter rule. Okay, don't sweat all the details of that. It's just what we will do is we're just gonna say use this rule, and bingo, that's the rule we'll use, and that will dictate what table we use to pull our numbers out of. And then there's mid-month. For real estate, you have a mid-month rule. And so which month did you put it into service, if you will? Did you open your apartment building? And there's a mid-month rule, and there's tables for that. So there's tables for all these different things. And we're going to be looking at examples and working problems for these. Now, there's also something the IRS calls a recovery period, and that's essentially right? We've used the term recovery period, and that's the IRS's term for. You might have 3 years, 5 years, 7 years, 10 years, 15 years. You might have 20 years. You might have 27.5 years. You might have 50 years. All of these number of years based on the kind of equipment or kind of asset that it is. I should have added racehorses since I mentioned them in class on Tuesday. Racehorses, I can't remember which one they are. They might be a 5-year recovery period, not sure. Anyway, so here's the list, and this list is in your textbook. Again, if we were to go to the IRS website, every asset you could possibly imagine, the list is, out the door. So the list we're looking at here is just a snippet, and you can see, and you'll be needing to look at this list for some of the homework problems to pick the recovery period for your asset. So you can see that, automobiles and pickups and things like that have 5-year recovery periods. You get further out, tugboat, wow, 10 years. Now, most tugs last a whole lot longer than 10 years, right? But they're going to let you depreciate it over 10 years, which is a good thing. Anyway, you can see what some of those are. Here's 25 years for like a barn, stuff like that. Municipal sewers, so once you can start depreciating, those, and get them depreciated over 25 years, even though they're going to last a lot longer. Residential real estate, so apartment buildings, things like that, with certain rules, 27.5 years. if we have time, we'll work through an example there. 39 years, 50 years, you see how it kind of works. So you'll have a depreciation schedule that may go out for 50 years depreciation. So here's the way that it works, the way Mackers works. And trust me when I say you'll need to read and understand the problem, the asset that you have, and then almost the entire challenge is, what table do I use? And you get the table correct. And once you find that table, the depreciation schedule almost falls into your lap. So here we go. Find the correct table. That's the challenge right there. Number one looks like that's probably the easiest part. Well, it's because we present so few tables in our limited exposure here, that may be pretty easy, but you still have to get the right one. Now, then you find the correct recovery period for the asset. So we'll look at the table here in just a second, and then the percentages, or sometimes it changes in your textbook, and it changes for me. So apologies all around, but sometimes you use a percentage and sometimes you use a decimal to represent the percentage, a fraction, between 0 and 1. So you should be able to look at the table and tell which is which. So you find the recovery period, you look in the list, you say, oh, there's my asset. What's my recovery period? Okay, got it. So once you're in the right table, you look for that column, the recovery period column for that asset. And then that column gives you the R sub M values, the ratios or the percentages that you will depreciate each year for that asset. And then you just take those numbers and multiply them by P. It's not by the current book value. It's not times P minus F. It's times P, and it gives you your depreciation schedule. Here's an example table. This is 200% declining balance using the half-year convention. You're going to see this in the spreadsheet as well. And these are the numbers. So very briefly, if your asset has a 5-year recovery period, then in year 1, you will depreciate 20% of that asset. In year 2, you'll depreciate 32%. And in year 3, you'll depreciate 19.2%. So in year 1, it's 20% of P. In year 2, it's 32% of P. In year 3, it's 19.2% of P. And you go all the way down to year 6, and then you're done. Now I have to say a couple of things here before we actually do this, because some of you might be confused. This says 200% declining balance. Well, that's true in part. It starts out at 200% declining balance, and then when it becomes advantageous to you, here truly the IRS is here to help. When it becomes advantageous to you, it switches depreciation methods from 200% declining balance to straight line declining balance. And you can see that happening in the table. Notice down here under 5 years, in years 4 and 5, they're the same. The percentage is the same. That's straight line. Let's look over here at year 10 years. Notice in years 7, 8, 9, and 10, they're essentially, there's some, you got to make sure everything sums to 1 here. So, but essentially they are all the same. So you can see that's when you switched over to straight line. So you double declining balanced down here until year 7. then you switched to straight line, so every year is the same. So these tables, the labels are a little confusing. The text explains it kind of. The tables are a little confusing in that, yes, it's 200% declining balance, but you have to change over. It's not straight 200% declining balance. You do switch to straight line, and you also have to use straight line to get down to zero, to actually get to a final book value of zero, which is required by Mackers. One other thing that you'll notice is that we won't go through it, but if we were to, if you were to look at, 200% declining balance, that's 2 over N, right? Well, if your recovery period is 5, well, N is 5. 2 over 5 is 40%. So shouldn't this first year be 40%? Well, yes, but not. This is the half-year convention at work. So in the first year, you get half of your depreciation. With 200% declining balance, it would be 40%, but it's not. It's half of that, so it's 20%. So you only get half the first year. And since you want to depreciate it for 5 whole years, you get half a year in year 1, then you get a full year in years 2 through 5, and in year 6, you get another half a year. So you get the 2 halves to make a whole, right? You get 4 full years in the middle, and then you get a half a year at year 0, and half a year at year 1, half a year at year 6, so you get 5 years total. And you'll notice in year 6, 5.76 here is 1/2 of 11.52. So it's still straight line, but it's half of that value. Now, you don't need to think about necessarily that going on, but it's built into the table. So the half-year convention is built into the table and built into these numbers that you're going to use. So that means that for each of these, the 7-year, the 10-year, the recovery periods, you actually depreciate it for 1 additional year. So there's 8 years of depreciation in a 7-year recovery period. And there's 11 years of depreciation in a 10-year recovery period. Okay, let's look at the example. So let's go back to the spreadsheet before we take a break. Gosh, where did it go? Okay, let's get back to this spreadsheet example. All right, here we go. Mackers depreciation. Now, what I've done in this spreadsheet is, you'll notice I've used a lookup function. If you're not comfortable with Excel, you won't know what in the heck a lookup function is. And if you're comfortable with Excel, bingo, you got it. You can use it to your advantage. But let me just, in a minute, I hope, explain where I'm coming from there. So in this last tab, I've got Mackers rates. And these are the numbers that we just saw. In that table, I've got a few more years, 15 and 20-year recovery periods. But this is a half-year convention. And this is for a 3-year recovery period, 5-year, 7-year. And this is year 1 for a 5-year recovery period. Here's year 1. It's 20%, just like we saw in the PowerPoint. And then in year 2, it's 32%, and in year 3, it's 19.2%. So I've repeated that, if you will, over here. And when I use that lookup function, what that lookup function does is it comes to this table and it grabs the right fraction, the right number out of here. And it does so by the arguments that I give the lookup function. So we'll do that a little differently when we solve a example problem. Let's go back to the table here. So in year 1, Mackers depreciation, we've determined, let's say that we've determined that the recovery period is 10 years and we're using the half-year convention. So we would know to look at, go to the Macker's half-year convention table. We'd find the correct table, and we would look in the column for a 10-year recovery period. And we'd find the right table, and we'd look at the 10-year recovery period. And these are the numbers. We would use these percentages. These are the R sub M that we'd use. So the first year is 10%. Our depreciation will be 10%. We'll take that 10% times P. And you can see that, yes, this is 10% times P, right? This is 10% of P, which I put here as the beginning book value. 10% of that is 15.5. And so here, you just take 155,000 current book value minus the depreciation for that year, and we get 139.5. What about the second year? Well, look, there's a lookup function. I made the call. I looked up, I grabbed year 2, or the second number in that column. But let's go back and look at that column and see what that is. So the second number is 18.18, 18%. In year 2, we will take the depreciation for year 2 will be 18% of the 155,000. Once again, it's always this number times P. So this number, 18% of 155,000, I'm gonna calculate it right here just to show you, equal 0.18 times 155,000 and 27,900. And son of a gun, there it is, 27,900 is the depreciation amount for year 2. And that reduces the book value accordingly, 111,000. So I would not need to continue to calculate the book values, because my depreciation calculation does not depend on the book value at all. My depreciation calculation is simply these numbers here times the $155,000 that is P. So I could calculate it right here. I'm not going to do it in the interest of time. Hopefully you kind of get that idea. And you can see that that's a reasonably accelerated depreciation. The first year is only half of the double declining balance because of the half-year convention, but all of these future years are greater. So we're depreciating more than we do with any other depreciation method after we consider the half-year convention. So now let's work through some problems. We'll take a short break, and then we're going to come back and we're going to work through problem 518, 20, and 22, which will be helpful to you in working the homework. So let's take a 5-minute break, and at 8:53, let's convene again to work through example problems. Wow, that 5 minutes always goes by just like lightning to me. And I'm sure, however, you guys are you just can't wait for me to show back up. Yep, yep. So let's look at example problems. And I got to, once again, I need a producer. I'm just not very good at uh, making transitions here. Uh, okay, first let's look at problem 518. Let me, I would show that to you, but I think I'm just going to read it to save the time and effort of switching back and forth. Here's problem 18. Prepare a depreciation schedule, and that's what a lot of these problems in the back of chapter 5 say. Prepare a depreciation schedule to be used for tax purposes. Aha. When it says to be used for tax purposes, that's a key phrase for, hey, we're doing Mackers here. So we're going to use one of these tables, a Mackers table for this. For $40,000 of computer equipment. So we've got P is $40,000. Actually, I wanted to make that. Sorry. I'm in my own way. So there's P, $40,000 of computer equipment using the 150% declining balance method and a half-year convention. Ignore any special depreciation allowances. Now, what that refers to is something yet to come, which we're likely not going to touch until Tuesday, just briefly, because I'm just going to talk about it for 5 minutes. But when it says ignore any special depreciation allowances, just kind of pretend that you're not looking at the back of the chapter where it talks about these special allowances. So the bottom line is we have a $40,000 asset that turns out to be computer equipment, and we're going to use the 150% declining balance method and half-year convention. Now remember, 150% and the half-year convention is fine, but it says for tax purposes, which means we're using Mackers. So when it says 150%, that doesn't mean it's 150% all the way. It means find the right table, which is actually going to be 150% with a switch over to straight line at the advantageous time. Don't just think that you can do that. This is asking you to do 150% declining balance, because it's not. It's asking you to look into the proper table. So if we look into the proper table, so we need to, first of all, go back. We need to find out computer equipment, what the N is, what the recovery period is. And I'm turning back in the textbook, and I'm looking on page 70 of your textbook. If you have a different edition, it's likely to be on a different page. But the heading here is IRS standard recovery periods and depreciation methods. That's the major heading for this. And I've got to look in this list and find computer equipment, and there it is, 5 years. So my recovery period N is 5 years. That's why, and you could tell that, right? Because I filled this out already. I filled out the R sub M, the percentages that you'll depreciate each year. Now, where did I get that? Well, it turns out that table 511, once again, that's the current edition of your text. It likely is the same table reference number for an older edition, but maybe not. But we might find that. We could find that. And I am going to just kind of flash that up here briefly. And I don't know how to do that except to stop sharing and just change the camera. So let's see how this works very briefly. And wow, I want you to look at this big one here. And you can't see it very well, but here's the 5-year recovery period, and this is table 511. And I've drawn these numbers. So you'd find this table, 150% declining balance, half-year convention. That's a table you use. There's 15%, 25.5%, 17.85%, 16.6%. So what I've done is I've just taken these numbers and I have moved those over to the spreadsheet. And I think you probably get that part. So they're in the spreadsheet, and as I go back to that, there they are. You have to trust me on those numbers. Now, depreciation amount. What is the depreciation amount? Remember, with MACRS, it's easy. It's equal to the rate, the depreciation factor for that year times P, which is in C3. So $C, $3. It's the same, right? We're going to multiply it by that every time. And therefore, there we go. I can just drag that down. That's our depreciation for each year. I'm going to do something here, equal sum. I'm going to sum these up, and they sum to 40,000 because we've depreciated the entire value for that asset over those 6 years. Remember, half year depreciation in year 1, half year depreciation in year 6. In years 2 through 5, that's 4 full years of depreciation. We depreciated the whole thing, so we depreciated it down to 0. Let's find the book value, although it doesn't ask to find the book value in the problem. Let's do that anyway, and we can find that the book value at the end of the 6th year is going to be what? Going to be 0, right? And there we go. So everything is roses. We have a wonderful depreciation schedule. Here's how much we're going to depreciate. This will be charged in our books of account as depreciation in these particular years. It'll show up as an expense on the income statement, right? And in our balance sheet, we'll have a contra account that will be accumulating these depreciation amounts, the contra account on the asset side to depreciate these values. So that's problem 518. I don't see any chat comments. I'm hoping that means we're good. We're pretty good on this. Let's go on to problem 520 if that's the case, and look at a little different sort of problem. And let me, I'm gonna have to go back, darn it, go back to the textbook and read you that problem. Okay, here it is. Prepare a depreciation schedule to be used for tax purposes. Ding, 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 right? MACRS. $40,000 of computer equipment. Huh, son of a gun. $40,000 again. Sounds kind of like the same problem, doesn't it? Using the 200% declining balance method. Now we're using a different method. And a mid-quarter convention. Whoa. So now we're going to use, so we can't use the table that I used in the first example with a half-year convention. We're using the mid-quarter convention. And it's computer equipment. So again, it's still 5-year recovery period, right? The equipment was placed in service during the 3rd quarter of the company's tax year. 3rd quarter of the company's tax year, ignoring special depreciation. Okay, So we've got mid-quarter convention placed into service in the third quarter. So we need to get those numbers. All righty, let's, I'm gonna see if I can get my camera there even lower to see if we can get it right. I'm now on page 71 of the textbook, and we're gonna look at this table. Hey, I'm getting better at this. Give me another 20 years. So this is table 5.9, and it says depreciation rates for 200% declining balance using the mid-quarter convention. Hey, that's what we're using. So we have to find this table. Actually, this among four of them, because this is the one, the asset is placed in service during the third quarter. If it was placed in service during the second quarter, we'd be using the table above the one that we're seeing here. And if it was put in service in the fourth quarter, we'd be looking at the table below this one. So so we're looking at this table right here, and that's good. So this was where we're going to pull our numbers for our problem. And I'm going to have to type those numbers in here. 15% and 34% and 20.4%, 12.24%, 11.3%, and 7.06%. Okay, so those are the numbers that we'll use. Let me switch back. I should have a made-up name for a producer and tell that person to do all this work that I'm doing myself. Okay, I have filled in that table then. Those are our R sub M's, the recovery rates for this particular asset. And again, so we do this exactly the same as before. It's in C3. And there's our depreciation amounts. And let me see, they must be different than before. They are a little different, right? Those numbers are a bit different than they were in problem 518. And again, we can do the book value. You can do the book value. And there we have it. And we could sum them up. I guarantee it sums to 40,000. And I could guarantee that because we know we depreciated it to 0 at the end of year 6. So there you go. Pretty straightforward. You just have to find the correct table to then look up the right, to get the right depreciation rates for each year to build the schedule. Multiply it by P. It can't be much easier than that. And that gets you your solution. Okay, quickly, 522 is the other one, and this starts to get a little bit interesting. And 522 says, prepare a depreciation schedule to be used for tax purposes for a $495,000 apartment building. It's really kind of a cheap apartment building. Anyway, the apartment building is placed in service in the 9th month of the company's tax year. Remember, this is residential. We have to do a mid-month. So we're doing a mid-month convention. So that turns out to be table 5.5 in my textbook. The cost of the land is not included, so we're not going to mess with the land. The land is a different animal. and land doesn't depreciate. So we're not including, we're ignoring land, and we're ignoring special depreciation allowances and cost segregation, which is another issue we'll breeze through. So what do we do with this sort of building? Well, as it turns out, we depreciate this over 27.5 years. I know I didn't make the rules, I just talk about them. So we have to depreciate that over 27.5 years, and you depreciate using straight line depreciation. So, but it's straight line with a mid-month convention. So it's not standard straight line. You have to adjust the first year and the last year. So if we use straight line depreciation, our depreciation amount, let's just say straight line here, is going to be equal, and we're depreciating it to 0, right? So it's equal to our P divided by N. $18,000. That's an interesting. Give me another one or none. $18,000 is how much we would depreciate each year. Now, so if I wanted to do, I could do an RM for the years. I'd end up doing a ratio and a multiplication. So we know it's going to be $18,000 of depreciation amount. I'm gonna, and remember, year 1 is different and the final year is different. So I'm gonna say this is equal to C5, and we would do that all the way down to year 28. Okay. So it's going to be the same straight line for years 2 through year 28. So 27.5 years, you can tell we're actually doing it for 29 years. Okay. So we're doing it for 29 years. We've done it for 2 through 28 is 27 years. So we've got half a year to go here, kinda. So we've got $9,000 more to depreciate since we've done it for 27. Okay, here we go. Moving quickly. Let me see if I can slap up this mid-month convention thing. And remember our problem. Darn it. Remember our problem said 9th month. So we're looking at the 9th month here. Okay, got to switch cameras. 9th month. This is table 5.5. And I've got to jack this thing up. Placed in service in the 9th month. Okay, 0.2917. So we will depreciate 29% of the annual depreciation in that first year, 0.2917. So you have to remember that number. Okay, 0.2917, switching back. And sharing and remembering 0.2917. 0.2917, 29.17%. And here this will equal that times our 18,000. And that gives us a depreciation amount in the first year of $52.50, 60 cents. Okay, so that takes care of year 1 all the way through year 28. Now, what's year 29? Well, year 29, the easiest way to find this is it's what's left. So in year 29, we have to get that book value down to 0. And so we have to depreciate what's left. Well, what I'm going to do here, there's several ways to skin this cat. Can I say that on the air? I'm going to just find the book values. Calculate book values all the way down the line. And let's copy these down. There you go. Now this tells me exactly how much I need to depreciate in the final year because I have to get the book value to 0. So my depreciation in the 29th year is what the current book value is, and that will give me then a book value of 0 at the end of 29 years. So there's there's the depreciation amount that you use in the last year. And that's it. That's residential property, 27.5 years. So don't let the half year mess you up, as sometimes it seems confusing. Yep, you really divide by 27.5. Yep, you use that to find the straight line depreciation for the overwhelming majority of the years. Then you use that table to get that first year's depreciation rate that you then apply to get the depreciation amount. And then you do this calculation just in the last year to depreciate what's left for you. Now, I need to talk about one thing, and let me go back here. I know I have very little time, so I'll expand on this a little bit on Tuesday. Let's say that that here in year 4, you decide this is a computer, right? Computer system. Right here in year 4, you decide to sell it, and you sell that computer. And you sell that computer, let's say that you sell that computer for $9,000. Well, okay, you sell it for $9,000. Well, the Uncle Sam will come a knocking, and he'll say, "Oh, I see that on the books it's $73.44, and you sold it for $9. That means that we let you depreciate it a little too far, and that means that's $1,656 that you will owe me taxes on." So this is called, the book will call it a capital gain. It's really not a capital gain. It's called a depreciation recapture, but that's another story. So you'll have to pay taxes on that excess, the $9,000 above whatever the book value is. If you sold it for less, for $7,000, that'd be a capital loss, and you'd get a tax break. But that's another. We'll talk a little bit more about that on Tuesday. So it's the weekend. Don't forget to set your clocks back early Sunday morning. Actually, do it Saturday before you go to sleep, and go to sleep on Saturday. Don't wait till Sunday to do that. Have a great weekend, and I will see you next week.